Eddie, if you want to take the floor. See you later.
Cool. Well, first and foremost, I want to thank my guest today, Attorney Joseph Furnari. I appreciate you coming today and talking to us a little bit about investor and some of the things that they should ultimately keep in mind as they set up their investment portfolios. And then additionally, I wanted to thank Lopez from Cross Country Mortgage, who is also with us today. He's going to be talking about some investment options that you can actually create the cash to make the deals happen. So you got to find the deals, and then once you find them, you got to be able to finance them. And Lewis has some interesting ways that you can do that. So I appreciate you joining us, Lewis, and sharing your knowledge.
Thank you for having me, Eddie.
Appreciate it. Just wanted to actually start off and kind of come up with a short agenda. If I could see the slides, that would be great. And then we can kind of go through some of the touch points that we want to talk about today. One is the financing options, ways to create that leverage. So Lewis, you'll be kind of filling us in on that. And then the second thing I want to go through is the legal risks, the concerns of the LLCs, understanding a little bit about tenant laws, fair housing, basically try to keep yourself out of trouble if you're going to be buying and holding a property. And then lastly, I want to kind of touch on some strategies for investing, whether that's a fix and flip that you're looking to do, a buy and hold where you buy it and keep it for rental income, BRRRR, which is basically buy, renovate, rent, and repeat. So that's what BRRRR stands for. So a lot of folks use that to buy distressed properties, get them all renovated and rented out. And then lastly, we don't have too much of this in our area, but Airbnb, short-term vacation rentals, student rentals, and house hacking. So house hacking, just to be really brief, that's where you would buy a house, make it your primary residence. Let's say that you buy a multifamily, you live in one of the units, and then you have the other two units kind of help you, pay that mortgage, and then subsequently, allows you to save some more and build wealth so that you can keep buying investment properties that way. So all in all, we're going to go through really brief the residential properties that you can buy, everything from condos to singles to multifamily 2 to 4 units. Anything beyond a 4 unit, is that right, Lou, that would be considered commercial?
That's correct. Yep.
So we're ultimately going to keep this narrowly focused on 2 to 4 units. And then lastly, kind of finding and analyzing the deals. So this way you can spot a good deal when you find one and then subsequently be able to jump on it. So let's just start off by Lou. We could take the slides down, and then Lou, if you could just kind of give us a little bit of background about yourself. This way we know who we're talking to, and then maybe go into a little bit about some of the options that you guys have available for investors.
Excellent. Thank you, Eddie, once again for having me. Look, I've been in the mortgage business since the year 2000. Eddie, I think you might have me beat because I remember when I was pounding the pavement, I always used to drive up Main Street and see Realtor of the Month on a sign on Main Street. And it was always Eddie Gutierrez. That was a long time ago.
Yeah.
And look, you've carried the tradition because you're still here and strong, and always a pleasure, hanging, talking, and, just being able to help people out together. It's just been a great journey.
Cool.
I'm very appreciative of that. So, look, one of the big issues we're having in this market right now is inventory, and I know, everybody could relate, especially all you realtors out there, because there's not a lot. I did a seminar the other day, a training seminar for realtors on this specific topic of rehabilitation and renovation and investment. And we did it in Monroe, right? And I believe there was about 22 1,000 residents in Monroe, and I believe there's only 11 properties for sale.
Yeah, so I looked up this week. We're down to 9 properties in Monroe,
Really?
and that's across all price ranges.
Right, staggering statistic, right? Can you imagine how low the inventory is? So actually our buddy at Cross Country is a colleague of mine. He actually specializes in the renovation loans, and I believe he found 2 distressed properties in Monroe that could have been, that could be, like he's always saying, I'm pretty much talking from a realtor perspective on advertising the properties, saying, cash only is really not what you want to put up there. You could be an investor, right? You could buy it, you could fix it, or you could be somebody looking for, to make one of these properties their dream home. You could just, finance it, build in the cost to fix it up, and and do it to your liking. Because really, finding that dream house right now is not that easy. Most of the dream houses are, priced out where, the average buyer that's looking to get out of a rental property to go into a home, it's a little hard because the prices are still high. And what's the worst thing happening right now? The rates are still high, and contemplating, nobody wants, as a loan officer, nobody wants to talk about high rates, but we have to, because the number one thing in the lending business that we have to do is to make sure every one of our clients is, uh, you know, able to make their payments back, right? You don't want to put somebody into a property, thinking, oh, wait a second, I just did something. This guy could barely make this payment, right? Well, look, we don't want to do that on the investor end either. So, with that said, like if you're looking, actively, if you're an investor, and you're looking in this market, there is inventory for some reason on the investor side, because that's last few months that's been most of the deals that I've been doing, and they've been working out really well. And honestly, this particular product that's up on the screen right now, investor only, I can't tell you, it's probably the easiest loan to get done in the mortgage business right now, because what they're asking, I mean, look, it's not a cheap loan to do, right? Because you're going to need a minimum 20% down. And when I talk to investors, I don't even recommend 20% down, because, it affects the rate on what you're going to get. And there's a big difference with that extra 5% at a 75 LTV versus an 80 LTV. We put it up there because it is available, but it's not something that, you really want to do at 20% down. So a simple math, you have a property, right, that is for sale, you just times that by 25%, you're going to have your down payment right there. you know they do carry, I mean, they do charge points for these deals, so you have to be aware that these loans are not cheap. And I make it very clear and transparent about it, because what, nobody wants any surprises, right? Especially when they get to a closing table and they see what their closing costs are, Joe.
Oh yeah, that's true. You don't want any surprises in that regard, and that's my job to make sure there are none. But and it's great because you're going through that initial stage, right? When you're dealing with what's the product I'm going to go with to purchase a property. Yeah, I'm not in that position, but the good part about that, and the good part about what you're saying right now, because it makes people wear that business hat. And it might be residential properties, but when you're going into real estate investment, it's not like, buying a painting on a wall and hoping it appreciates. In order to be successful, especially from a legal perspective, and to protect yourself, is to be wearing that business hat and to be operating and planning on operating from business. And that first step is to make sure, the loan and the initial acquisition and all the numbers make sense. And sounds like, you do a great job of making sure that people who are, in front of you are prepared from the get-go, and learn, or at least are educated about the products that are available to hopefully, set them up to be successful.
Right. And also, I mean, like you said, it's got to be profitable. You got to know that what you're putting into it and what you're going to get out of it is going to be to your advantage. And you have to just make that very, very clear in the front end, because if you don't, you're going to find yourself getting some callbacks.
Yeah.
So
So, I mean, that's one of the clear things that you're identifying with the investor is to, their ability to repay that loan, right? So,
Mhm.
um, and it's expensive compared to where we were with rates, a year, 2 years ago. But in the end, uh, you're going to be analyzing the numbers, making sure that the debt service is covered by the amount of rent that they're bringing into the property, right? So, what are you looking in terms of debt service rate ratio coverage? Are you looking for there to be how much over the rent? Like, is there a specific amount, like 1.25% of
Um,
rental income, or
it's a great question. Okay. There's different percentages, right? You could be like at a no ratio. You could be flat, like $3,000 a month, $3,000 a month, right? You could be under by 1%, or you could be over by 1%. Preferably the 1.25 is the target percentage that you want to hit in order to get the best rate. Because when it comes to that, it doesn't mean you can't do it. Okay, wait, my mortgage, and look, this makes sense. Why are you going to go into a investment property? It's going to be flat, right? You're going to pay $3,000 a month, and you're going to, charge $3,000 a month, right? So you want to be at a level where you're at least at 1%, 1.25% over what your intake is going to be in order to be able to make some kind of money. Now, um, some people, what they want to do is, they get into a certain property, right? They don't mind if they're under. Why? Because maybe the property's not, it's livable, but it's not in the greatest condition. So they'll take it, right? They'll do the loan. Somebody may be living there. What they'll do is they'll upgrade it. They'll fix it up, boom, 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 boom. And then a year later, they'll raise the rent 500, 600, or 6 months down the road, 500, 600 bucks. Now they're showing a profit on a monthly basis.
Mm.
So they're not worried about that negative 1%, right?
are
Um,
is that something as a lender that you're diving into? So, like rent versus rental potential based on an improvement?
Well, I mean, look, you want to put that on a table with an investor. I mean, look, most of them, what they usually do is actually fix the property up, right? Because they know it's added value to them. And most investors are, they're, the most of the investors that I get are pretty much contractors or people that do a lot of the work themselves, where they cut the cost
Hmm.
of improving the property to increase their profit.
Okay.
Um, which obviously you got, you probably run into the same thing. Most of the people you have buy investment properties are pretty handy, you know what I mean, where they do the
Right.
work themselves. Um, and look, they, I really don't have to let a lot of these people know because I know they're coming into that. But when we get together, like for example with you, we let people know, look, this property is like this, but in the future it could generate this, just with
Yeah.
what you're capable of doing.
Okay.
And I just wanted to jump in there real quick
Yeah.
because a lot of times we're talking about the front end, right? And then
Hmm.
as an investor, sometimes it's easy, particularly in the beginning, to not think about the exit part, right? So you did the work, you got it to where you wanted. This is more for a flip, than a hold, obviously.
Hmm.
But there's a lot of things, especially if you're lucky enough to get a buyer during the construction process. There's a lot of things to keep in mind about how is their lender, the buyer's lender, going to going to appraise this property, making sure the correct protections are in place for both sides within the contract. Because now it's not really easy in your experience in Eddie with a general real estate contract at that point. It doesn't include all the language that you kind of have to think about. So there's a lot of addendums in place in Fairfield County. Obviously, we go to the bar contract, so a lot of the language goes in there about, okay, is there going to be a new construction warranty associated? Does the buyer have any rights to pick particular finishes and stuff like that? I know it's something that kind of works through the process, but a lot of times investors, it's probably good for them to keep that in mind on the back end too, when discussing about whether or not they're going to dive in and invest in a property.
Okay. Yeah, man. One of the things that before we started the call that Lou mentioned was, investors should kind of keep in mind that they got to keep the loan for a period of time, right? I think that was what, to 9 months or something, Lou, right?
Yeah, about minimum 6 months.
Minimum
Sure.
Usually
6 months.
require.
Yeah. So, yeah. So, I mean, being able to create leverage like this gives you a really good opportunity to perhaps go in there and do a fix and flip, but just know your timing, right? So you don't get hit with prepayment penalties and things like that.
Well, it's good that it's good that you mentioned that. Sorry to cut in on you, Eddie, but I just got to remind everybody that this type of investor deal is not your common Freddie, Fannie, FHA deal. This is what they call a non-qualified mortgage, and just so you know, it will come with a prepayment penalty because of the nature of the loan.
Yeah. So look, it's all, and I tell this to clients pretty frequently, is that a lot of financing is really just analyzing risk, right? So, and the more risk that the lender's going to take, the higher the rate. Typically, usually you have those things tied in like prepayment penalties because they want to make sure that they're covering the risks on their end on the banking side. So with this, you said, ideally you can do an 80% loan to value. Better to do a 75%, so this way you don't get hit on the rate. Is there any other tips that you can give to an investor if they're looking at this type of loan that will help them save on the rate?
Well, right. Well, that 5% makes a big deal, right? Because remember, the higher the LTV, the lower the payment, right? Which will create that percentage for you that when we price it out, it'll be more favorable. So,
Gotcha.
so when you pass the mic over, I mentioned this is one of the easiest loans to do on the market right now. Let me explain that. Okay, and it's going to sound a little surprising, right? I probably mentioned this to you before. Really, all you need to is the appraiser goes in, fair market value. Now that I brought that up, you got to remember if there's a lease in place, you have to check that lease, right? Because you could run into a little trouble with the current lease if they're only getting $1,000 a month. Your payment's gonna be $1,500 or $2,000 or $3,000. That's not gonna work, right? Because there's a tenant in place already, right? So you always
Gotcha.
got to pay attention to that when it comes to this product. It's going to be either, what the potential rent is going to be if you have a renter lined up, or what the fair market value is on the appraisal. Okay. So basically, why I say this is the easiest loan to do on the market right now is because that fair market value comes in with the rental on it, right? Here in Fairfield County, I mean, it doesn't take much to have a pretty high rent in this area. So that's one of the things that it has to do. The rent has to cover the payment, right? And all you really have to do is you have to show the assets. So 2 months bank statements, no employment, no income on the 1003 on the application. So this is literally, what they call as a NINA, no income, no asset. I mean, no income. It's really no income, no employment.
So you're not even showing your employment. You're not showing.
The only thing you show, I didn't mean to say NINA. I mean it's no employment, right, and no income. On the 1003. We keep it blank, and there's no income. I'm talking if you own 10 properties, we don't even put your income because we don't require any tax returns either.
So
Wow.
It sounds
I
crazy.
guess my question, So what do they look for as far as the assets then? A certain number amount?
Yeah, you have to have usually we run with 6 months reserves.
Okay.
And
so
closing costs.
That's what they're looking for, 6 months
down payment,
bank.
Payment and closing costs. You have to have the money. Now, here's a little more crazy, right? Down payment could be gifted. So if you're an investor as a family member that's got money, you could gift down payment. Not closing costs and reserves, though. That's got to be your own money.
Gotcha.
So I don't know how much simpler I could make it than that, other than you have to have a decent FICO score. Guys, you're going to come in. I pulled 620 FICO score. We probably, it probably won't get done. You pull a 700, anything 700 and above would be a lot easier loan. Can we go lower? Yeah, but it's going to be tough. So,
sure.
Good credit is a must on this product.
So that's right? The key. The key is to have good credit and then have a good amount of money in savings that you could show as reserves, the down payment, and then you're not really asking for much beyond that, right? Like you're asking for a couple months of bank statements, and then
That's it.
and then the last, I guess, key piece of the puzzle is that you're going to look at how much rent will be made from this property, and you're either looking for something that's just better than even, right? So,
It would be to the borrower. It would be to the investor's advantage. Absolutely, based on that's how we calculate rate. So it would that's a big factor.
cool.
But look, you're not as an investor, and let me tell you, I've been, the ones that I've closed, people just call me back. I had a young man call me back. He's bought his third property. He's done this loan twice. He's already gathering the funds to buy his fourth because it's like, this is easy. This is a no-brainer. It's so easy to get done, and I don't have to go through all the red tape of tax returns, properties. Look, some people have a lot of properties. Can you imagine? You fill out an application, you don't have to put down what the rents are on the properties, or provide leases and docs for all the properties. They are going to require some, because they want to make sure that you're insured, right, and that you pay your taxes on time. But that's that's it. They're not going to go to that Schedule E and look at all your deductions and then just tell you, oh wait, you know what, that's not going to happen, right?
So with this, Lou, you started talking about reserves. So if I'm this guy, I'm on my third property I'm about to acquire. Are you asking me to have 6 months reserves for each of the assets that I own?
That's a good question, man. Negative, just on the property you're purchasing. Remember,
Really?
it's no
Wow.
income. There's no income, so you're not putting anything on the other properties. You're not putting what a mortgage payment is. You're not putting what you get. You're not putting anything on the other properties.
So
Reserves are based on this purchase only.
Only on that one. That's crazy.
I know. I tell you, it's going to sound crazy, but it's true.
And were you referring to real estate taxes or income taxes, as far as making sure those are paid on time and everything like that?
Real estate taxes.
Gotcha. So really, just your income is.
Yeah. Remember, there's no tax returns.
Yeah. Interesting.
There's no tax.
We actually have a question too. Nina asked what the name of this loan option is.
It's called DSCR.
So the debt service
reduction.
Debt service coverage ratio.
Something like that. Yeah.
So you essentially, debt service meaning the mortgage payment. You just the
rent covers the mortgage payment.
Yeah, it's not really snazzy name, but it does the rent cover the payment, and that's it. Yeah, look, as you mentioned, right, like the rate on this product, because they're not really doing an in-depth study of your finances. It's something that it's going to get translated into the interest rate, right? I imagine. So you're, and we talked to numbers previously, and I hate to have you throw out numbers, but yeah, it's probably, you said, around 2 points higher than where rates are normally.
It depends. It really depends. It depends where your income, where your rent calculation comes in at.
Okay.
Whether it's above, below, a par, it really depends. It really depends on that, and your FICO score. I mean, it's a relative of all those things combined.
Gotcha.
And your loan to value, right? How much you're putting down. But and look, sounds crazy is a good terminology for this type of product, but you have to remember the upfront, like Joe mentioned, when you set the expectation from the get-go. This is not for somebody that's trying to buy a property with very little money. And I'll give you a perfect example. To be comfortable, let's say you have a $300,000 purchase. Okay. I would say you need a minimum $100,000 to buy this property. That's simple enough.
So you're gonna get like $75,000 for down payment,
Right, and then the rest would be
And then
reserves and closing costs.
Okay.
All right, so just on the average, right? And then you got to remember, escrows could be up and down depending on taxes, insurance, whatever.
Gotcha.
So that's just a ballpark calculation, just to keep it simple math. 300,000, you need 100 grand. Some people call them, they've called me, oh, can I do 10% down? No. Can you do 20? Yeah, but right.
Yeah.
25, you're going to be golden. Okay, I could do 25. So let's go.
Okay.
Oh, and the other thing I want to add, that sounds crazy. I usually clear these things to close, and this is not just me, but it's cross country. We've cleared them in 3 weeks.
Oh my! So you can do
Simple.
this loan in
So you can
within
move
a
quick.
30-day close, bro. That's pretty
Right.
cool.
Yeah, we could clear them if everything's clean. If everybody's proactive on the file, because sometimes you run into some hiccups, but if everybody's proactive on the file, we could clear these things between 3 and 4 weeks. Not an issue.
Cool. That's awesome. Well, hey, I appreciate you sharing that with us, and yeah, I think some of the other things that we talked briefly about offline was, you have the ability to create leverage in other ways, right? Like you have the ability to do a home equity line of credit if you're sitting on a lot of equity in your home. You said you could do a cash out refinance in many cases where you ultimately, that might end up being an additional option that you should explore if you're looking to take the equity out of your home to try to invest in real estate. And then I know that you had mentioned a product that you can do for single family homes only. It was home style. Is that right?
Home style, yeah, home style is
Yeah.
correct.
So that'll allow you to, as an investor, to buy a single family dwelling where the down payment doesn't need to be 25%. Is that right?
I believe it's 15
15.
minimum. I think it's 15. I'd have to double check on that one, Eddie. I personally don't do a lot. I haven't really personally dealt with home style one family investment. Just look, I'd love to do them, but usually they come in multifamily, and it's just not that popular of a product on the market. But it's definitely there and available. And it wouldn't be, but that's, we're talking a little different. It's a little different because we're talking rehabilitation now.
Yeah.
So let's go back to DSCR. DSCR is not a rehabilitation program.
Okay.
We're not going to lend you money to fix.
Thank you for clarifying that.
Yeah. DSCR is investor, money making properties. Like, they have to be livable. Like we mentioned, most investors go in there and do all the fixing up on their own, but this is not related to, buy a distressed property, and fix it up, with the money that we're lending you. DSCR is totally, ready to move in, already occupied type of product. So
Okay.
you want to definitely keep that in mind. As far as moving into alternative investment opportunities, as far as rehabilitation, that's when you would get into the fix and flips. The fix and flip scenario where you have a distressed property, you purchase it, and we lend on the money to to reconstruct, and then you flip it within 12 months. Everybody who's familiar with that knows that it's kind of like a bridge loan, right? It's like a 12-month deal. That's all you get. After that, you want to be out of that. You want to be out of that loan.
Sure. You brought up something good about that, though. So you're only loaning for this product, an occupied property with leases in place.
It could be empty, though. They could be empty.
It could be. That's what I was going to ask. Right. What if it's empty, but are you going to require them to get a lease in place prior to closing that shows the income, or is it just
the appraiser is going to determine the market value? Sure. Most realtors, Eddie, and most realtors could determine what fair market rent values are, and they can make their client comfortable, assuring that it'll appraise. Because, like I said, Fairfield County, you're gonna get your rent.
Okay. So you're just looking at, so if it's unoccupied, the appraiser is going to give an idea of what the rent can be for that property. and then subsequent to that conversation, you'll lend on it if if it covers the payment,
Yes.
and then
Mhm.
you're ideally going to get some favorable rate or more of a favorable rate if it covers the payment and then some, right? Like you said, the 1.25
Right.
times or
Absolutely. We have
the
like I was going to put up a sheet, but it's a little complicated. So you have to put in a lot of numbers, and
yeah.
it'll tell you. I mean, my calculation will tell you where you would be at as far as the rent and all the payments. Once I get taxes, insurance, and everything that's going to be, all the costs on the property, it'll tell you where you're eligible as far as that percentage is concerned. The other thing I wanted to touch on DSCR, I said they have to be livable. It doesn't have to be impeccable though. It doesn't have to be an impeccable property. As we know, there are a lot of properties that may look distressed, but they're livable.
Mhm.
People just live there, right? It's just that's just part of it. I mean that is fine. There is absolutely nothing wrong with that as long as the property is livable. You could um, you could do this loan. The other thing I want to touch on is that you want to. I think I mentioned you this offline earlier. Also, when you do the contract, right, make sure your inspections are taken care of before that. They
Mhm.
will not. They will not approve the loan until all repairs are done. So if there's any contingencies on repairs on the contract, this is good for you, Joe, because when you do a
Yep.
contract and it's for DSCR, wait a second, they're going to require termite, they're going to require this, it's going to be, if the sell that'll slow this deal down tremendously. Because everything
Absolutely.
there's no wheeling and dealing on it, that you're not going to have everything's got to be done. It's got to be rentable, move in.
Hmm. Makes sense.
Makes it a little
So
harder on the realtor end, right, Eddie?
I think in Fairfield County, right, or at least in Upper Fairfield County, the norm is typically to create some sort of like binder, right, Joe?
Absolutely.
And then you go to kind of the contract phase with the bar contract. So it might be conducive to that kind of a scenario where you
Sure.
make the offer, you do your inspections, and then once you get to a full-fledged contract, that's what you're going to get, Lou. So that way it's absolutely clean, and doesn't have a lot of other stipulations. If it, like you said, if it has other repairs or other items that the seller is supposed to take care of, like a termite treatment or something of that nature, you're going to want to see, Lou, that those things were done before the bank's going to loan on it, right?
Actually, no. We don't need to see that they were done before or anything. You got to remember, in the mortgage business, an inspection's an option.
Yeah,
It's not a requirement,
Hmm.
it's true.
right? Unless we're talking this type of product here, so it's not a requirement. You don't need to have an inspection at all.
Well, and look,
That's just
so
favorable. I know.
yeah,
We
And then
recommend it
for
to the
you, for
clients, and
you,
they're
incoming
like,
the
"What's he
attorney
talking
saying,
about? Wait a
wait a
second. What am I
second.
talking about? Oh, the appraisal's required, but we
Yeah.
don't require an inspection on the property,
Yeah.
dude.
yeah. Look,
That's
I
just
think
Obviously, yeah. And
that's a
it's
good segue for Joe, because Joe, I mean, we never really want to advise that anybody, even an investor who may
no,
be
no. And
seasoned.
Of
but
course not. That's not what
Yeah,
I'm saying. Yeah, I'm not saying
no,
that,
no, that's
right?
not that's
We
not what he's saying at
highly
all. He's just
recommend
yeah.
an inspection. I'm just saying that, we don't require it.
But this goes back even to the first comment. In this situation, it's a little bit different than when you're dealing with someone purchasing, a home for themselves,
Correct.
because this is a business deal. At the end of the day, it's a residential property, but it's a business deal. Now, so if you're choosing to not do an inspection, that's a business deal. That's a business decision. And just like in a commercial deal, you do your due diligence. The law is going to be less, it's going to be less protective of you when you're dealing with your business hat on and not your personal hat on when you're buying a property to live in. But that said, my perspective, you always have to, definitely do an inspection and figure out what the deal is. But it sounds like you do an inspection for this loan, right? You have some items, barring anything crazy, you get those things taken care of quickly, get it re-inspected, they're all done, and then you move on, right? So if your binder says, okay, we have a 10-day inspection period, we do that inspection in 5 days, we report there's 3 items that need to be done, we get those items done within a week. Now those items are done, we move on to the bar contract without the inspection contingency. We show that to you,
Perfect.
you're done, you're good.
That's it. We're good. We're not going
You
to
know what I
require
mean?
anything because
Perfect.
there's nothing on there.
Perfect.
Perfect.
And now, so you could kind of do your job on that underwriting stage with the binder, but you could kind of hold off a little bit. You could do some of the other stuff that you need, gather documents, but wait until that period's over. Now we're on to this new bar contract showing it's clean on inspections. That's what you get from
I wouldn't
that
even
was
put it on a
missing. You
binder.
plugged in it.
I wouldn't
You wouldn't
even
even
put it
do
on a
it.
binder.
There you go.
No, you don't need
Gotcha.
to. You don't need to. Eddie, I want to go back just so you're clear on what DSCR stands for. It's right in my flyer. It says debt service coverage ratio.
Yeah.
See it at the bottom there, loan program. So
Yeah,
I think that was a question what it meant.
So I think the 2 bullet points that really jump out at me is you could do this 30 times. It says the finance up to 30
up to 30 properties.
properties. And then the other thing that jumps out at me is you could do this for a pretty high dollar amount. So you can do $2.5 million deal.
Yeah.
As long, I guess the caveat is you got 25% of 2.5 million.
Can you imagine what the rent on
Right.
2.5 million property is going to be?
Yeah. So, look, there's a phenomenal way to kind of finance something, not have, your, a forensic study of your finances done, so that it's a pretty painless process from what you're talking about.
Mhm.
Now, I want to segue into kind of some of the things that you want to do on the legal side, just to kind of set yourself up, so that we now have the money, you're gonna do the deal, and then subsequently, what you should be doing to set yourself up so you could reduce your liabilities and be protected legally. So, Joe, if you don't mind, just kind of touching base a little bit about some of the you know, things that people should avoid so that they don't fall into those pitfalls.
Absolutely. First of all, and again, alluding back to one of my first comments, when you're investing in real estate, some people could look at it as a hobby, but it's got to be looked at as a true either side business that you're doing if it's not something that you're doing full time, or if you're trying to do it full time, you have to treat it that way. You have to treat it like you're, the CEO of this real estate management company, and you have to operate it that way from start to finish in order to truly get the protections from any asset or liability protections that are available to you. And the first thing people always ask is, should I or should I not set up an entity such as an LLC to hold title to the property? And I would always suggest absolutely. The further you distance yourself personally, the likelihood you are at least one step removed and one step protected from personal liability in case of anything happening. Now, does that change your ability on the financing end? Possibly, but possibly not. It depends on how they view the LLC, and there's personal guarantees involved, but that's all stuff could work from, right, Lewis?
Oh, hey Joe, real quick, we can close in an LLC.
Perfect. See, so it's people, lenders know how to deal with that. It might be a different product or whatever, but they know how to deal with that. Sounds like this product is certainly sounds like it's one that's set up for an investor anyway. So if they weren't accepting people who are operating through an entity, then that probably wouldn't be good for business as far as the product's concerned. But What I like to let people know is when you're doing this, it's not enough to just set it up and then move on and put the deed in the LLC's name. In order to get the full protection, you need to have the underline, the underbelly, the background documents that even if you're the only member of the LLC, if it's really just one step removed from yourself, you need to have an operating agreement. You need to have a filing process. You need to show that you're operating as a business, as a real estate management company in a way, in order to get those protections. Because if something were to happen from a liability standpoint, a slip and fall, and whatever it is, you want to protect yourself, but it's going to be very easy for an even not so talented plaintiff's, injury attorney to go after your personal residence or go after your personal assets, even though you had this LLC set up, if you're not operating it in that capacity. In other words, the checks for rent need to be paid to the LLC or to maybe another LLC owns the holding company, stuff like that. The way you operate is the way to fully, best protect yourself from a liability standpoint when you're diving into the investment of real estate. I always suggest, listen, there's tons of complicated ways you could set it up to make it more difficult. Some people are in that market, some people aren't. It doesn't matter, but at least something should be done if you're going to be a real estate investor, to remove or at least do what you can to remove yourself from personal liability on the holding side, on the ownership side.
So Joe, you mentioned an operating agreement. That's something that I need as a realtor. Oftentimes, if you're as an investor, you're looking to buy a real estate owned property, as we call it, like a REO. So real estate owned is a category of property that's usually also identified as bank owned, foreclosure. So those are perhaps some of the more common ways people refer to them. So when making an offer, you usually have to show, if I'm making an offer on behalf of an LLC, let's say that it's a cash offer, I'm going to need to show, an operating agreement for,
Exactly.
who are the authorized signers for that LLC.
Yeah.
So that,
and it
way,
really has to do, and it really has to do with showing the authority to act on behalf. Who are the actors? Who has the authority to make these decisions for this company, in order to make sure that there's nothing fishy going on as far as the decision making to sign the documents in the future. That's why it's important, and that's why it's important even if you're the only one, right? Because a lot of times, from the business perspective, that operating agreement is really designed, at its core, to be the agreement between partners within an LLC. It's really a partnership agreement. But even if there are no partners and it's a single member LLC, you want the operating agreement. It's the only thing that shows how that company is managed. And again, I can't say this enough. You need to operate and manage that LLC as if it's a true business, because it is a true business, in order to get those full protections, because those protections aren't going to be there if really it's just used for all personal reasons and stuff like that, and you don't really separate it from your personal stuff. That's the whole reason for the protection. So I always suggest that people do that. Sometimes they do it later, and there's always another big question that comes up too, is if you have multiple properties, could we have one LLC owning all of them, right? That's kind of a big one too. You can, and it does provide that level of protection as far as removing yourself as the primary holder. But still, just like with any other company, if you only have one LLC owning one property, right? That means every property that's held within that LLC is subject to the same liabilities. So if you own two properties, if something happens in one property, the equity, or the value of the other property is still
at risk,
liable and at risk. Absolutely.
So what I'm hearing you say is it may be good to think of kind of a single property LLC where Yeah, every
if
property
that's
has
some, it all depends on what people's price ranges are and what their abilities are, what they want, what they value. And again, just like on the loan side, it's a risk valuation.
Yeah.
What do you feel wearing your business hat as an investor? What are your risks? What kind of risks are associated with this particular property? People, as for a one-story ranch, might be a little less worried about the risks than a three-story condo building type deal for whatever reason.
Mhm.
So there's different things that go into play about the kind of protections that are available and what they're willing to spend on doing that, or would have the complexity, because it's not always easy to operate in this fashion. But like I said, it's the best way to protect yourself. The more complex, the easier it is to protect yourself.
Sure. Now, do you mind kind of just touching base on, the importance of, staying up to date with like tenant laws and things of that nature, just to keep yourself out of trouble?
Absolutely. I mean, there's tons of experts in the landlord tenant field, but the one thing you need to know, especially if you're in a Connecticut market, and even more so in Massachusetts, it's very favorable to tenants. They're going to get the benefit of the doubt in the eyes of the law. So always keep your best foot forward and educate yourself, and just every year just update yourself as far as any changes that might take place with landlord tenant law, right? And make sure your lease outlines the agreement, right? Because anything that's vague or anything that's omitted from a lease is going to go in favor, in case of a dispute, is going to favor the tenant, unless it's something that is basically not included, unless it's something that's consented to in writing through the written lease, right? So it's generally going to go that way, because the landlord, in that sense, right? And again, it goes back to wearing your business hat when you're a real estate investor. The landlord is seen as the business, right? As operating from a business, and the tenant is always seen as just a consumer, right? Just like the difference between a commercial and a residential type situation. In this case, it's more like the landlord is acting as a commercial entity in a way, and the tenant's acting as the consumer. So the law is always, particularly in Connecticut, it's going to favor the consumer in this particular circumstances, wherever there's an omission or whether there's vagueness within the language of the lease. So it's something you always want to pay attention to. You always want to update your leases, especially if you're going, if they're usually a 1-year term. Every year, you just want to check in, whether you have an attorney that you work with regularly, whether you have an attorney who you just use one-off, any relationship you might have. You just want to have that maybe in the budget, or just something that you deal with on an annual basis to kind of audit your leases, right? Instead of just kind of flipping them over or even having them as a holdover tenant. Make sure you update that information. Make sure it's as favorable as possible to you as a future or current landlord, so that you don't have any hiccups and don't deal with it. Because it's one of those things that when you're getting into real estate investment from a legal perspective, you have to operate it like a business.
Good to know. Thank you. So, yeah, so Lou, you had kind of that experience when you were, you've had investment properties. You was that something that you recommend also? Like you would have, renewing the lease, making sure that everything was up to date, having it reviewed by an attorney.
I got to be honest with you guys. And look, I wasn't, I was an investor by default. We had bought a beautiful loft, right? The ones up in Bridgeport, Lafayette Lofts. Eddie, thank you. I think you sold both my units, right? They went pretty fast too. Very, very fortunate to in an up market. We bought them in an up market, and we ended up not faring so well. But actually, I had such good tenants that I really never, I didn't establish an LLC, and I should have, but just never got to that point. And look, hearing everything that I'm hearing now, I probably should have. Like I said, I was an investor by default. We owned 2 units. I own one. My
Mhm.
wife owned one. And then we moved to a house, and then we were left with these 2 units. What do we do?
Yeah.
The
Sure.
market was down when we moved, so we couldn't sell them. I mean, the loft we bought like at an astronomical price.
I hear that.
So the only option was, all right, hon, well, let's just rent them out. So we
Yeah.
rented them out, and we had long-term tenants. At first, we went with university students, which I definitely should have had an LLC. Oh my God,
Exactly.
what a nightmare!
But that
but
again goes to what kind of business you set up too. If that's your market, that's what you want to do, and then you just got to make sure you're set up to deal with that. You know what I mean?
Yeah, I mean they just cost me so much money. Just
Exactly.
every time every year a student will move out. We did it for 2 years because
Yeah.
the university was right there.
Sure.
So look, and addressing me with this question is actually good if anybody's listening. LLC is definitely the way to go to protect yourself, because we noticed at the end that we were definitely at a high risk. With owning properties and not being, not protecting our personal assets. If I could give a little advice, and I know we've lived this when it comes to investment properties, and look, I'm not gonna mention anybody in particular, right? But the one thing that I hear a lot when I have a client call me, I'm gonna rent out my basement. And I tell them, I go, look, you got to be careful with these, these apartments that you rent out. You got to make sure that if you have a 2-bedroom house, that you're, a two apartment, a 2-family home, it's only 2 rents. Okay, don't rent out the attic, don't rent out the basement,
Mm-hmm.
because I'm sure, if something happens in one of these units that are not supposed to be rented out, I don't even think a liability is gonna, an LLC is gonna protect you. So
No,
I don't
and
know.
that's going to be an insurance thing. That's going to be you're
Yeah,
insured. You're
there you go.
insured
Take
for,
over, because I'm.
you know,
That's where I don't.
that's
That's where
right
I
there. I
beg.
mean, boom, boom. Something happens in the basement. You rented that out separately, and and you don't have a fixer that could get in there and sweep it up and make sure that it looked like that it was just a regular basement accident. Boom, your insurance company is wait a second. This is insured for a 3-bedroom unit, but something happened in the 4th bedroom. That's clearly a 4th bedroom that you tucked away here that it's not zoned for in the basement. So we're not covering it.
Yeah.
You don't want that. Because basically your first line of defense is always your insurance, right? So
So what would their liability be with the tenant also? Like if something happened, the insurance. I mean,
absolutely. I mean, that's the insurance. I mean, first of all, you're going to look
you're
for
talking property with
replacement costs.
insurance, but tenant
But
itself with
if something happened with the tenant itself and it wasn't a safe place for them to actually have a residence, have a dwelling, then it's a whole nother can of worms you're looking into. And then nothing, honestly, nothing in writing could protect you from that. At
Right.
least is my experience. Nothing could protect you from breaking any of the laws. And but unfortunately, the reality of it is,
It's a lot.
this is the reality of it, especially in the student market business, the student rental business, whether it's over there by Sacred Heart, whether it's wherever it is, Fairfield UB. People are going to squeeze. They want to milk the cow as much as they can. They buy an asset. And that's and I get that. That's wearing the business hat, but those are the risks that they need to make sure that they understand going in. Hey, no one could tell you to not take a risk that you're not willing to make. What I'm saying is be educated before you make that. And there's a lot because in that situation, what makes it even worse as far as when you're sitting in my seat is that they didn't even know if they were doing something wrong. 9 times out of 10,
They
savvy
know.
investor, they know.
Yeah, they know.
But that one time that you had someone who was new and didn't know, it's because they bought it from the seller who's been doing it for years, yada yada yada, didn't think anything, and something happens. That's the heartbreaking scenario that you don't want to hear about.
Yeah.
And to answer your question, Eddie, about as far as me owning investment properties, I kind of like I said, I didn't go the LLC route, but I did benefit from it. You know, I mean, we were able to cover mortgages, make a couple dollars. And even now, but now the way the market is, I wish I still had them.
I'm sure.
You know,
Sure.
because I would be going from, you know, 1,300 a month to, you know, you saw my units, impeccable. You know, we kept them.
I mean, right now you'd probably be
Don't tell me. Don't save it.
save it.
No, you can tell them. Tell them.
You don't want to know. You don't want to know.
No, look, a lot of those, you know, the loft one that you had,
Those are
it'd
cool,
probably be
cool
close
spots.
to $2,000 right now.
Wow.
So yeah, definitely like almost like around 1,900. So yeah, I mean, the rental market has increased with the inflation. I know one of the folks that that I know was going to join us today to listen in was talking about kind of like the market and whether or not we thought a correction was coming, and you know, whether it's a good time to invest now or wait. And that, yeah, I would say this, yeah, it's kind of like investing in the stock market as well as investing in real estate. It really comes down to not the timing of the real estate, you know, making the investment, but more the time in, right? Like how long you've owned the asset. You know, so over time, over a long period of time, you're always going to do well, right? Like the asset's going to appreciate. You're going to see upswings in the market where, you know, right now where rental prices have gone up, you know, and then those are the wins that, you know, I think you'll see over time. If you kind of delay, and don't make the decision to you know, to dive in, you may miss kind of the swing, right? Where you'll see, you know, you and be able to ride the wave, right? And Lou, I love that you kind of mentioned, you know, you had a downward wave, right? Like, you know, where you saw the real estate market went down. You know, you bought these things at a higher price. You weren't able to sell them. You had to keep them reluctantly as an investment, simply because you couldn't sell them because you would be selling them at a big loss.
And I survived. I mean, the
Yeah,
rents covered the more. I mean,
yeah,
you know, you keep the units in good condition, they're going to rent. You know,
yeah.
people want to live in nice places.
Yeah, so I think overall, like time in really is really the thing that saves you with real estate.
And I think the kind of investment as well, particularly in this market. I mean, it really in any market, I mean, not necessarily, but if it's an asset that you're looking for passive income from, I mean, that income's going to theoretically be there, and the asset might go down, up in value, but theoretically, you're still going to be able to get income out of it. On the flip side, that's a different story. You know, if you buy something at the wrong time and you're holding it, and your plan was an exit in a short period of time, and you don't time it right, then you could obviously get hurt.
That's a gamble. Yeah.
You know, that's what I'm saying. So it always depends on how you're looking at it. And I always, like, any investor clients that I have, and we're talking about that, I always remind them that's kind of how they have to, like, what is your goal with this property? Is it something that you're going to use as a retirement tool, so you're not going anywhere with it for the next 20 years unless, you know, you have to, or is it something that you're looking to make a quick buck on? So that's kind of what it is.
So, do you mind throwing up the slide really quick so I could just show different strategies? Yeah, I mean, kind of identifying a good deal. Yeah, it really comes down to determine the areas that you want to invest in. Ideally, as Lou was talking about, like he had owned a property that was near university, right, and yeah, it was almost a shoe-in for you know, having university student rentals. That wasn't his intended use. It just ended up working out that way. Yeah. So ideally, you know, if you're trying to determine what's a good deal, just know where you want to invest firsthand. And then secondly, become a student of what's going on in that area in the market, right? And by that I mean, you know, do some research with Zillow. Get on a website feed like ours where you're just constantly looking at the listings. So, you know, if you see, you know, let's say you're looking at, you know, somewhere near University of Bridgeport, you're looking at the condos that are around there. You're like, hey, I want to get one of those so that I could have it as an investment. Well, if you're constantly looking at those week in and week out, and they're at a certain price, and you see something that's extremely lower, you're going to be able to flag opportunities pretty quickly. And then some of the other things, once you identify the deal, you're going to need to know, if it needs rehab, you kind of need to school yourself about what contractors charge for remodels. Kind of be a student of what's going on with material costs, right? So look through Home Depot, walk through Home Depot, understand what it's going to take to do a kitchen rehab, a bathroom rehabilitation. As you talk to different contractors, electrical, plumbing, you kind of have an idea of what some of those folks are going to charge you if you're going to get into fixes and flips. So I've come up with a few examples just to kind of show folks what types of investments they can make. Here's something that we had, for example, in New Haven. It was sided on the outside and had vinyl window replacements, but the inside was a total wreck. We listed this thing a week ago for 125. It's under contract already. I suspected it needed around $50,000 worth of work to kind of remodel the kitchen, remodel the bathrooms, the 2 bathrooms that I had. But the expected rent would have been $2,300 a month, and the after repair value would have been $220,000. So if you were looking at trying to do this with the Burr method, which is buy, rehab, rent it, refinance, you'd basically have dumped in $175,000, and you would have had an equity position of almost 50 grand, right? So almost instantaneously, and then you would have been able to rent it for a higher amount, which is something that Lou was talking about earlier, right? Go into the property, kind of rehabilitate it, and be able to improve the rental that you can get from the property. So that's one example. And here's just kind of a sample of, and anyone who wants this calculator, it's a spreadsheet, kind of breaks down like even further what knowing your number is going to be super important. What are the taxes? What are the insurance? What are the other expenses you're going to have associated with this property, maintaining the lawn, other maintenance costs? The one thing that I see people skip a lot is a vacancy reserve. Reality of the matter is you're not going to have you may not have the property rented, 100% of the time, right? So you may have to factor for some form of vacancy. And then, breaking that down to, total expenses and what have you, in that scenario, you would pretty much pull out, the $125,000 that you initially invested to buy that property. You could pull it back out and then go buy another one.
Eddie, I'm going to chime in. I just want to let you know that I did have a recent investor that I did a cash out on their investment condo.
Okay.
And they took the money and bought a property cash across the street.
Perfect.
They're going to end up renting that out, refinancing it to get the money out, and they're going to buy another property. So in other words, they're borrowing money from one property to the next property to the next property, and they're going to end up, they're doing cash deals with their own equity.
Yeah.
They're not using their money; they're using the equity it's their money, but they're getting it out of the current homes that they own. So they're up to 5 houses right now.
Perfect.
So
yeah, I mean that's a perfect strategy to kind of build a portfolio. Just keep leveraging the equity from your current assets that you have, just to keep rolling it into buying another one, and then you increase your rent rolls, and then you also ultimately you're going to put yourself in a position where you can retire. So some of the other strategies that other folks can consider is doing fix and flips. You said, Lou, that you have a loan option for that. That you can get folks into. Here's an example of something that's in the Brooklawn area, Bridgeport, on Laurel Avenue. It's on market for $210. This thing's a wreck inside. It's gonna need about $100,000 worth of work. It's a 6-bedroom house, and it's 3,600 square feet. So ultimately, the after repair value, which is what ARV stands for, is on the low side is 450. So I mean, you could see there's margin there for somebody to make, right? So these are types of things that people could tap into. And then so here's another strategy that you can employ is kind of a buy and hold. If you bought a multifamily, you buy it for, let's say, 290. Ultimately, the current rent roll was 2,800. I think the ultimate opportunity here is to improve the rent rolls, right? A lot of times the current rents are low. And Joe, is there any, once you get a property, let's say you have an existing lease with somebody, usually is it at the end of the lease that you would be able to kind of renegotiate with the tenant?
Yeah, I mean, barring the tenant being willing to renegotiate their lease in the middle of a term for a higher price, you wait till the end. You provide them notice. The proper way to do it is to provide them notice that the terms of the lease are going to change within a certain amount of time. Usually about 30 days beforehand would do the trick. It's not really required in that case. The only time certain notice would be required in the lease is if you're planning to not take an option or not allow them to use their option to renew, that kind of thing. But generally speaking, you're going to have to wait till the end of that term, which is usually a year, to renegotiate the rents.
Okay.
Absolutely.
So the last strategy I wanted to kind of show was something called house hacking. We didn't call it this back in the day. This is basically the idea, like you go in there, you're going to buy a primary residence. Perhaps you're using an FHA loan. It's not the loan that, Lou, you were talking about, right? Like on this scenario, if you're a primary residence, you're going to get the benefit of being able to use something like an FHA loan, not have to put a big down payment.
That's correct.
And then here in this scenario, this thing had a 3-bedroom unit on the first floor, 3-bedroom unit on the second, and rents in that area are going for like about $1,850, $1,900 for a 3-bedroom. So you can get around $3,700. Your principal and interest is going to be about $4,400, roughly, including all those expenses. So you'll be able to live not rent free in the third floor, but you can certainly live there, just paying a minimum of $690 a month on your part. Allows you, if you took, the third floor apartment would have normally rented between $1,500 and $1,600. So that person gets to pocket $700 in there, in the bank, and hopefully with a lot of discipline, that person puts $8,500 into the bank a year, and then calls Joe back in about 2 years' time and says they want to do it again, right?
Sure.
So they're going to live in, they're going to move from this house on Parrot. They're going to keep it as an investment, and they now have enough money saved up in their savings to go ahead and buy, another 2-family, another 3-family, perhaps in a different area of town, and say that that's going to be their primary residence.
Back up. I'm sorry.
Go ahead.
Yeah, it's FHA has a 100-mile rule.
Gotcha.
On moving and buying another property, so you won't be able to do another FHA loan.
Okay, so
the 100-mile rule.
Thanks for the clarification.
But your wife might be able to.
Yeah.
I don't know.
No, well, look. There's different ways of skinning the cat here, right? But you got to remember, if you file jointly, okay,
sure.
you're both, benefiting from the problem. No, I know, but look, it's happened before.
Sure.
We've been able to do that. And the other thing I want to mention is very hard to approve a loan owner occupancy from one multi to another. There's got to be a level of it's got to make sense. You know what I mean? It's got to be considerable distance, job change, all kinds of compensating factors in order for that to happen from the under. I'm not an underwriter, but look, we've run into all these situations where we would probably tell, no, that's not
So
going to work.
you're saying it would be easier though if to go from the multi to a single, for example.
Oh my God. If you're in the future of buying your first investment property, you must buy a multi first. It's a gimme. You do the multi first, and then you find your dream house, and then you save enough money to buy your more investment properties as you go on the way, along
Gotcha.
the way.
Cool. But look, I'm end here with the last strategy with Airbnb vacation rentals. Look, this one is in Madison, Connecticut. It's along the coast. It's a block from the water. It's a 3-bed, 2-bath. It's on for $359,000. It's something right next to that property. Was actually so the mortgage calculated would be somewhere in the neighborhood of $2,500 or $30,000 a year. Summer rentals in that neighborhood, right on that same street, for June, July, and August, are renting for $10,000 a month. So $10,000 a month.
That's crazy.
That'll cover your yearly mortgage. And then academic rentals right on the same street. We're renting for about $2,000 a month, and those run from September to May. So that would provide you, $18,000 a year in perceivable profit, right? But let's be realistic. You're going to have expenses associated to maintaining the landscaping, running an Airbnb. You have to be a good Airbnb host, and you're going to probably have higher expenses than normal. So we factored maybe around $5,000 in expenses. That's going to be on that initial investment that you have, say $80,000 to $100,000 investment. You're going to have around a 10 to 12% return on your initial investment. So, so here you have, you have the ability to, look at deals, identify them, understand what you want to do, what strategy you want to employ, what area you want to be in, become a student of that area, and then subsequently, make sure that you get on board with Lou to actually get, the access to the capital that you need. Make sure that you speak with Joe so that you can make sure you structure everything correctly. And then not only structure it correctly, but operate it correctly. Because structuring it and then forgetting won't help you on a legal battle, right? So you're gonna want to make sure that you operate it correctly. Make sure that you set up that LLC and run it, have a bank account, so on and so forth. Guys, I really, really do thank you immensely for joining me today and kind of having this real estate talk, investment talk, and I'm hoping that a lot of people gain some good information about what to do setting up their investment portfolio. And I think, dive in, really, like, don't let fear, just kind of get a hold of you. I think a lot of it's just arming yourself with good team of individuals like Lou, like Joe. You're gonna win every time.
And Eddie.
Yeah, and Eddie, absolutely. Yeah, just like we say, stay informed, get your work group together, and you should be all right.
Cool, guys. Well, I appreciate you guys.
Thank you for having me, Eddie.
For joining me today and going through, some of this, and hopefully we'll be able to catch you on the next one.
Yeah, thanks, Cynthia, and the bank crowd too.
Yeah,